Okay, hi everyone. Thank you for being here today. My name is Fedor Petrenko, and I'm a first-year SOM FES joint degree student. And in a moment, I'll be introducing Joe Indvik of SparkFun, today's speaker. First, I'd like to make a couple announcements. This talk is co-sponsored by the Sabin Sustainable Venture Speaker Series and the Blueprint for Efficiency webinar series. And this talk is being broadcast live, so if you have a question, please remember to press the little microphone button at your desk. So the Sabin Prize supports Yale student and faculty efforts to start sustainable for-profit businesses through cash prizes totaling $25,000. The competition provides feedback from professional judges, extensive mentoring from faculty, and opportunities for participants to meet and pitch their ideas to venture capitalists and industry leaders. And the Blueprint for Efficiency webinar series provides a platform for leading practitioners and researchers to explore energy efficiency through the lenses of behavior, policy, finance, and technology. And just one more announcement. So applications for the Sobotka Seed Stage Venture Grants are due on November 25th. The Yale Center for Business and Environment is soliciting proposals to support student faculty efforts to launch new startup ventures in the field of business and the environment. The application deadline is 8 p.m. on Tuesday, November 25th, for the opportunity to receive a $10,000 seed stage venture grant to launch your business. And if you guys want any more information on any of the above, just visit cbay.yale.edu. That's cbey.yale.edu. That's the Center for Business and Environment's website. So without further ado, Joe Indvik is an entrepreneur and consultant focused on scaling solutions for energy efficiency and developing new approaches for financing efficiency technologies. He's the co-founder and president of Sparkfund, a Washington, D.C. startup that has developed a truly innovative financing solution for small and medium-sized energy efficiency projects. Prior to Sparkfund, Joe was a consultant in the climate change and sustainability practice at ICF International, where he led the development of a new advisory service for energy efficiency finance. He's worked with diverse clients from hospitals to higher education and from Fortune 500 companies to federal agencies, all with the goal of making smart investments to improve building energy efficiency and reduce environmental impact. Before Sparkfund, Joe was at Dartmouth College, and before ICF, Joe was at Dartmouth College, where he received a degree in economics and environmental studies, and that's actually where I first met him. Had the great pleasure of working with Joe on the Dartmouth College Green Revolving Loan Fund, and I can tell you he's a true visionary and leader in this space. So without further ado, it's a great honor to introduce Joe Indvik.
Thanks, buddy. All right. Thanks, Fedor. Awesome to be back at Yale, guys. Actually, I had a funny blast from the past about Yale a couple days ago. After a couple drinks, my girlfriend and I decided to break out our old college entrance essays just to see how terrible they were. And I finally found mine, and at that point I had no idea I wanted to do energy efficiency or climate change or anything like that. So I wrote an essay about why history is important to me. And it had this terrible line in there about how history is like a spotlight shining out from the past and illuminating the path before us. And I'm just cringing the whole time that I'm reading this. For some crazy reason, Yale actually didn't let me in, though I applied early action. So I had to flee to the frigid north and attend a little school called Dartmouth up there, which actually turned out to be a pretty good decision. But in all seriousness, it's good to be back. I got pretty familiar with Yale and the Yale community when I was applying, and it's really a warm, amazing place to be. So both the undergraduate campus and the School of Management and FES. So thank you guys for the honor of coming to talk about SparkFund. I'm going to just jump right in here, actually, before I do that, to talk about unlocking the small energy efficiency project market, and particularly how better financing, smart technology, and new startups like SparkFund and others can make that happen. So in the next 30 minutes, I want to talk a little bit about who I am and why I live and breathe energy efficiency finance. I'm going to talk about some of the market barriers to getting efficiency finance done, particularly in the small project space. I'm going to talk about how we think, at least, SparkFund is changing the game on small project finance for efficiency. And at the end, I'm going to issue you all a kind of a big, hairy, difficult challenge, which I think is the best way of expressing one of the monumental tasks we're facing in solving the energy efficiency challenge and getting capital deployed at scale in the economy. So something I want kind of everybody to think about and have a good discussion about during Q&A, hopefully. So Fedor covered this pretty well, but my background, I started off at Dartmouth, eventually gravitated towards an economics and environmental studies background, and helped work with Fedor. Fedor was the real mastermind on the Dartmouth Green Revolving Fund, by the way. We just sort of kind of got the wheels turning. but established a $1 million revolving fund to finance energy efficiency projects and then recapture the savings from those projects and revolve them back into the fund for continual investment. And after Dartmouth, I left and went to ICF International, which is a consultancy in DC. I did an interesting mix of kind of federal policy work, supporting EPA on climate and energy policy. But more interestingly, I also got to work as essentially a sustainability management consultant. So I got to walk into Fortune 500 companies, federal agencies, nonprofits, whole range of other organizations, and help them green their operations. So it was looking at everything from facility upgrades and pure engineering type upgrades, all the way to better incentive alignment so that facility managers were incentivized to conserve energy. So we got to get kind of a full spectrum perspective on how efficiency works at a whole wide range of organizations. And the moment I realized I wanted to dedicate probably the rest of my life and career working on energy efficiency was we were doing an ASHRAE Level 1 audit of an equipment distributor. The distributor shall remain nameless, but it was a fairly large distributor that primarily dealt in energy efficiency equipment, so light bulbs and HVAC systems and a whole range of other equipment types. And we walked in to do an ASHRAE audit of this building, and there was something weird going on the wall. So we said to the facility manager, "What's that up on the wall?" And he said, "Well, we had an old HVAC unit kind of jammed in there, and we decided we didn't want it anymore. So we pulled it out, and we stapled a bunch of cardboard up there in the middle of the winter to keep the cold out. And then we never really wound up fixing it because I don't really have any financial incentive to conserve energy in this building." There were literally efficiency equipment supplies sitting 2 aisles over in this warehouse. That's when I realized that efficiency isn't just a game of economics, it's a game of behavioral economics, right? And there's a key difference there. You can talk about the financial returns of efficiency all day long, but there are some really key behavioral economics and even psychological components to getting energy efficiency deployed. And if the incentives aren't aligned correctly, and if the services provided aren't sort of aligned with the needs of the business, then it's not going to happen. That was one of the core kind of reasons I decided to work more in the space. And then I worked with a couple of guys at ICF who wound up being my co-founders on SparkFun. So 2 other consultants from ICF, plus a 4th co-founder that we brought in from Intuit, the financial software company that manages TurboTax and Quicken and some other financial software packages, and founded SparkFund in February of this year. So I'll talk a little bit more about SparkFund later, but really the kind of genesis of SparkFund was getting to work with a range of clients on their energy efficiency challenges and realizing that small project energy efficiency is one of the biggest gaps in financing in the country, and we need startups that are specifically focused on that segment of the market. So Fedor tells me pretty much everybody here is familiar with the basics of energy efficiency, so we're not going to go too in the weeds here, but there's three important points to remember. Energy efficiency is a massive potential market. McKinsey and others estimate that it's approximately a $400 billion plus potential market for efficiency investments. That's domestic, net present value, positive investments with current technologies. So that market is only going to grow. Obviously, energy efficiency is a good investment at the organization level. It's very common to see 3-year paybacks on efficiency in the average building portfolio, everything from churches and charter schools all the way to commercial. And of course, if you ask me, energy efficiency is the key to stopping climate change. It's actually been estimated that it's possible to achieve about a 23% reduction in US building energy consumption just by making that net present value positive $400 billion investment. So 23% cut, it's pretty dramatic. And things are only getting better. So this is one particular example of how technologies in energy efficiency are evolving. But that gray line there you see is for LED technologies. It's the dollars per unit of light generated, basically, and how it's evolved over the last decade. That's almost 2 orders of magnitude decrease in how much it costs to produce a lumen of light from an LED light bulb. So LEDs are kind of the most extreme example, but there are a whole range of other efficiency technologies that are getting better and better every year from a technical perspective, and thus more and more attractive from an investment perspective. So this market's only going to get bigger. So the question is, why isn't that investment happening? We clearly aren't seeing deployment of capital into the energy efficiency projects at the rate that it should be for the kind of the economically optimal rate. So why exactly is that happening? Well, let's first identify, how do we know there's a problem in energy efficiency finance to start with? Well, we know that potential returns have outpaced investment pretty dramatically. So if you can achieve a 30% ROI with a 3-year payback project in the average building portfolio, and capital isn't flowing into those opportunities and capturing them, clearly there's something structurally wrong about the way that we're deploying money into efficiency projects. Second is that's the sort of top-down approach. If you take the bottom-up approach and go directly to customers and ask them about financing, customers pretty unanimously say, and when I say customers, I mean managers of buildings and everything from the commercial to the nonprofit space, pretty unanimously say that they cannot consistently find capital for small project energy efficiency upgrades. I'll talk a little bit more about some of those specific surveys later, but they're telling us it's a problem. And third, if you look at the economy-wide, sort of the systems-level approach here, clearly deployment of energy efficiency is way below the economic and social optimum from the perspective of pollution, from the perspective of the energy budgets that local small businesses and communities are sinking into energy usage, from the perspective of climate change, pollution, and a whole range of other impacts. It's pretty obvious when you look at the numbers that our deployment is below where it should be. So we know we have a problem. But it's a structural problem. The market is structurally underserved by existing financing options. And what I mean by this is it's not the kind of problem you can sort of stand by and watch, wait a couple of years, and the capital will show up. There are innate structural problems with the way that money is deployed in the energy efficiency space, and structural problems with the way that current financing players are addressing this space that make it structurally impossible for the capital to flow as it should right now. So it's a hairy problem to be addressed, but one that can be solved with the right technologies and the right approach. So everybody kind of has their pet 10 reasons that energy efficiency isn't happening. If you Google blogs, you'll find all kinds of top 10 and top 5 lists and barriers to energy efficiency. I think the small project market is one of the biggest, if not the biggest, barriers to getting efficiency done, and one of the least discussed. So I want to kind of frame this problem for you quickly here. So we have a $400 billion economy-wide opportunity in energy efficiency. A statistic that blows my mind is that 50% of building energy consumption happens in buildings that are less than 50,000 square feet. So it's buildings that are essentially a small supermarket or smaller. So you rule out skyscrapers, a lot of university buildings, office spaces, even ruling out residential. This is only commercial. You rule out all those buildings. The remaining buildings that are left, like small businesses and churches and charter schools and synagogues and community centers and those types of buildings, small commercial buildings, constitute about 50% of the energy consumption in the US. By extrapolation, we can assume that they then roughly represent about 50% of the efficiency investment opportunity. So we have roughly a $200 billion small project opportunity here. The number that's the real kicker is that 60% of those projects lack financing. So there was a study done, a couple of studies have corroborated this, but there was a study done by Jewel Assets recently that actually polled several thousand energy managers, facility managers, and contractors and said, okay, tell me the list of efficiency projects that you're considering, number one. And number two, tell me if you have financing for that project. And a whopping 60% of the projects under 500,000 or so reported that they do not have access to capital. So that's no access to internal capital, and external capital is either unavailable or too high priced or difficult to obtain to make sense. So there is a massive $120 billion, at least, small project opportunity to be addressed here. And that is exactly why we founded SparkFund. So SparkFund has a dual mission of both unlocking the small project energy efficiency market in some ways that I'll talk about in a little bit, but also in creating a new asset class of standardized small project efficiency investments that investors can feel comfortable placing their capital in. So a little bit of background on SparkFund. It started off with 4 co-founders. It's now grown to a team of 13 since February of this year, so it's been pretty rapid growth. We raised a seed round in February and are just about to close on a Series A round, currently a much larger Series A. We're based in Washington, D.C., and SparkFund, the one thing you should know about our particular financing product is at its core, it is a straight equipment lease. It's the same kind of equipment lease you would get if you were leasing a copier or a printer or a forklift or a truck or any other type of industrial commercial equipment. But we've layered some technology and some kind of contract structures on top of that that make it a lot more user-friendly and accessible for small projects. So before I jump into the details of what we're doing at SparkFund, anybody can incorporate a company and raise some capital, talk to some investors, and finance a couple of projects. But to truly say that we're addressing the small project market, we have to overcome those structural barriers I was talking about that are preventing capital from flowing into the space. Right? We want to be market transformative, not just a small startup that does a couple $1 million in deals here or there. So the 3 barriers that we've really focused on trying to address with our technology and our business approach are these. The first, and I think the most important, is transaction costs. So this is one of the reasons that you don't see a ton of big financial players getting involved in the small project finance market, is they have configured themselves to be large, relatively obtuse, management-heavy organizations who have long, lengthy diligence processes and pay senior executives $300,000 to $400,000 a year to diligence projects personally. it's very hard for them to shift to looking at small projects. So if they have a fixed transaction cost of, say this is a big bank we're talking about, for example, if they have a fixed transaction cost of $50,000 for every deal they do, if it's a $5 million deal, that's fine. If it's a $200,000 deal, they've just destroyed their margins just by moving into that segment of the market. So being very aggressive about getting transaction costs down is one of the keys to doing this project, or doing this sector right. Second is it's a highly disaggregated market. And this is not something not everybody appreciates, but there are about 10,000 contractors installing energy efficiency equipment in the small project space. So this is everything from almost literally 2 guys in a truck in the Midwest screwing in light bulbs to medium-sized energy service companies, manufacturers, vendors, a whole range of other service providers. But these contractors tend to work in sort of disaggregated regional markets. Sometimes they'll only work in a single state with a single technology type. Others will work regionally with different technologies. So they're not standardized. They all sort of speak a different language. They work in different sectors and different geographic regions. But what investors want most of all is standardization in their deals. And it's very hard for them to get comfortable with efficiency as a new asset class if they can barely understand the market that's generating that asset class. So one of our biggest challenges is to aggregate that project market up into investable tranches. And then third is that bigger is not always better when it comes to financing structures. So one of the trends that we've seen over the last 10 years or so is fancier and fancier, for lack of a better word, contract structures for efficiency finance. It started off with this whole idea of an energy savings performance contract, where a company like Siemens or Johnson Controls will come in to a university or a big company and simply do all your energy efficiency for you. You get to keep a small chunk of the profits from that, but they get to keep the majority of the savings. So it's a vertically integrated, management-heavy, very hands-on approach to energy efficiency. And we've seen a lot of riffing on that recently. We've now seen energy savings agreements and managed energy savings agreements and a whole range of other contract structures. But they're only applicable to the large market, $1 million plus projects at minimum, usually 5 million or more, which obviously doesn't represent the majority of the market. And the trend has been towards more and more complexity in those contracts. And very few of the financiers who are participating in those new markets are looking back at the small project market and figuring out how to streamline and reduce complexity and increase accessibility to the small project market. So one of our goals is to kind of not necessarily turn that train around, because I think it's a good development for the large project market, but to think in a totally new asymmetrical way about how to streamline financing down to its core pieces for the small projects. So a couple of the specific ways that we accomplish that, I want to talk about SparkFun's 3 core value propositions. So the first is the way that we aggregate projects and the way that we do so cost effectively. So there's sort of 3 pillars of our project aggregation approach. I think the first and the most important is that we do almost no direct-to-customer marketing. All of our projects, or at least the vast majority of them, come to us through our installer network. So we have a network of many dozens of installers, manufacturers, developers, utility program implementers, essentially anybody who's already out there in the market selling energy efficiency. And we package our financing along with their sales process. And then we equip them with software tools to easily originate deals for us. So that gets our customer acquisition costs through the floor, because we can have a single partner who might bring us 50 or 100 customers in a given year, and that's one relationship we have to manage rather than 100 relationships we have to manage. And I'll talk a little bit more about those software tools in a second. We also have a very data-driven approach to pipeline management for projects. So one of the challenges with small projects is that in order to get to an appreciable scale, you have to do a large volume of small projects, right? $100 million deals is a very different beast than $100 million deal from a management perspective. So we use an almost statistical approach to think about pipeline management. So we use Salesforce, the CRM solution, or customer relationship management solution that many of you have probably run into, in order to do some really rigorous tracking of our pipeline. Because if you think about originating 100 deals for us means we probably have to have 300 to 500 project leads to start with, assuming or even a pretty aggressive conversion rate. So that means managing many dozens of deals per day per sales manager. So what we've done is essentially taken the Salesforce platform and built some additional tools on top of that to be very statistical about our pipeline management. So we can understand when a project comes into our pipeline, where it drops out. If the customer says no at some point, we know why it happened, how big the project was, what the nature of the customer was, why they dropped out, a whole range of other data about that, and can start to kind of compile some essentially inferential statistical analysis of why pipeline works in some places and doesn't work in others. So we might find that small businesses tend to drop out of the process when we ask them for their financials. They might not have their financial statements prepared because they're small and they're not that organized. You might find that larger churches and charter schools, for example, might drop out when we get to the pricing piece of the process, where they didn't realize that the cost of capital was as high as it was going to be, and therefore they drop out of the process. So we have a very good, kind of keen, data-driven understanding of how that whole, how the market perceives SparkFund. And then third, we have what can only be described as a borderline neurotic attention to workflow efficiency. This is a key strategy for us for getting transaction costs low. So everybody at SparkFund is a huge Excel and process nerd. So one of the first things we did was take the entire project onboarding process from the time that a contractor brings us a deal all the way through diligencing that deal, pricing it, documenting it, executing it, doing the transactions, and closing it out. Took that entire process and mapped it out in Excel at excruciating detail. So we know every email that goes between every person, what's attached to it, and what the next step is. And that has two really cool and sort of important benefits. First is that onboarding for employees becomes incredibly easy. I could take a fresh college graduate who wants to be a sales account manager, train them for 5 hours, and basically could have them doing 90% of the project process because it's all so well documented. It sort of divorces it from the individual's knowledge and sort of makes it into a neutral process that anybody can follow. But more importantly, it also lets us be very data-driven in the way that we think about process, and lets us do some cool analysis to figure out where exactly in our company's business operations the inefficiencies are, and then build automation tools and software and process improvements to kind of shore those up. So one interesting analysis I'd like to show you. We can't quite do this yet because we're relatively early stage, but this is something, my kind of vision for what our process efficiency approach is going to look like. So through the Salesforce platform, we're going to be able to track every single action that each account manager takes, when they take it, and how long it takes. So we can say, okay, there were 2 days that elapsed between the project coming to us and giving a pricing offer. And there were 3 days that elapsed before the next step. And we can also measure the kind of level of effort or amount of staff time essentially spent on managing that step. So once we get enough data here, we can sort of plot a neat graph like this, where we can see each stage in the project onboarding process. On the x-axis, you can see how long it's taking in days, and on the y-axis, you can see how much staff time it's taking. So we can look at this and say, okay, it makes sense that the application stage is actually not very intensive in terms of our own internal staff time, but it's taking a long time because the customer has to respond to questions about their financing application, and they're delaying, and they don't want to do it, that kind of thing. Or we could look at the technical review stage and say, okay, that makes sense. It doesn't take us very long to do it, but we have to invest a lot of staff time. Our in-house engineer has to look at this, spend 5 or 10 hours on the deal, so we're spending a lot of time there and a lot of transaction costs. So what we can ultimately do with this data is look comprehensively across our whole process and say, okay, how do we get cost efficiencies by sort of smashing this graph down, and how do we get volume efficiencies by smashing it inward and reducing the total turnaround time on projects. So the second key, and I'm going to go pretty far into the weeds here because I think you guys might be interested in seeing some of the cool installer-facing and customer-facing tools that we're building. So as far as the installer experience, one thing you got to remember about installers, particularly these small project installers, is that they have a sort of love-hate relationship with finance. So on the one hand, they're losing a lot of deals because their customers don't have the capital. So we've heard numbers ranging from 20 to 40% of the projects that a contractor proposes actually gets to the proposal stage, completes a technical assessment on, and presents to the customer. Up to 40% of those, the customer says no because they don't have financing. So that's a lot of lost time and energy and cost for that contractor. So if the contractor can then have a ready-made financing solution to offer to that customer on the spot, it's a huge boon for them and lets them close on more deals. But the kind of flip side of that is that some financing solutions take a very long time to implement. So if you look at some state financing programs or some utility financing programs, the turnaround time on those programs can be 3 to 6 months or more sometimes. So if a contractor has to kind of wait around for that whole process to be approved, they're very likely going to lose that customer and lose the deal. So from a contractor's perspective, they might close on 20% more deals with financing, but if it takes them 30% longer to close on those deals, then it's not obviously a net positive for them, and they're going to move on. So the key to offering financing to go along with small project sales for contractors is to be quick, simple, streamlined, and non-disruptive of their normal sales process. You have to integrate seamlessly with the way that they already have conversations with customers. So a few of the ways that we're doing that, one is that we're moving towards a custom online CRM interface for contractors. So this would be essentially like, currently it's all website-based, but will eventually be a platform that a contractor would log into and propose a project. So they could say, here's the project, here's some basic details about the project, click enter, and it gets shot into our system and starts going through all the steps that I described before. And then whenever an action is required from the contractor, like, okay, now it's time to notify your customer to submit their financing application, or now it's time for you to revise your technical specs, they get a little notification through the CRM. So it becomes a one-stop shop for that contractor, really simple, light touch approach for them to understand where all of their projects are and kind of manage them seamlessly. Eventually, we're very aware that there's a sort of what I call tool fatigue in the market, where everybody has their own CRM solution, right? So piling another CRM on top of that isn't always the best approach. So we're looking at some API-driven solutions where we might be able to piggyback on top of a contractor's existing CRM solutions that actually offer API integration with the SparkFun interface. It's kind of a pie-in-the-sky vision right now, but I think one that's realizable in the future. As I said before, we offer direct sales process integration to the point where we equip that contractor with the tools to actually talk about SparkFund in the same conversation where the customer says, I can't do this, I don't have capital. And the kind of ultimate culmination of that is we would like to eventually provide a SparkFund iPad. So this would be a SparkFund piece of technology we hand to every contractor, and it's preloaded with our pricing tool so they can spin up a pricing estimate for the customer on the spot. It's preloaded with the basic lease language so the customer can review what the lease is going to look like. It might even have a little bubble you could click that would pop up with a SparkFund customer service representative to talk through any possible problems. So the whole idea here is to take the entire financing experience and condense it into a single streamlined iPad experience, which is something that nobody's really doing in the small project market yet. And then on the customer front, dealing with customers is a whole nother beast. One of the most important things to remember is that when you're dealing with a Fortune 500 or with a campus like Yale, large organizations like that have dedicated staff whose job it is to think all day long about energy and sustainability, right? Energy managers, sustainability managers, kind of what Fedora used to do at Dartmouth. Most small organizations don't have that benefit. So the person you're going to be engaging with as a financing partner is a CFO, a CEO, a small business owner that's working 80-hour weeks. And they must be forgiven if energy efficiency isn't the #1 priority on their list. So your task as a financing partner, and SparkFund's task, is to make this as streamlined and simple an experience for them as it can be. So I have what I like to call the before coffee test. So if you guys are like me, you probably aren't capable of like higher order thinking before you've had your coffee in the morning. So the whole point is that the SparkFund experience can be something that you can do before coffee. So it doesn't require an hour-long conference call. It doesn't require a lot of super critical thinking. It's like, here's the thing you have to sign, here's the next step you have to take, boom, 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 and now you have your financing. That's really the goal that we're getting towards. So in terms of the specific customer experience, I actually want to show you this rather than tell you this. So I'm just going to go through this real quickly and then demo one of our online tools. But we have an online application so the customer can submit all their financial information online. We have a pricing tool that they can play with online to actually get a pricing estimate in real time. We have a 2-page lease. This is something I'm unusually proud of. I wasn't really expecting to be innovating much around legal documents in this world, but it turns out that the complexity of contract structures is actually one of the biggest barriers to getting efficiency done. You hand a small business owner a 50-page lease that covers every possible downside risk scenario. Half the time they're just not even going to look at it, or even more dangerously, they might sign it without understanding it and therefore wind up defaulting or not behaving correctly under the contract. So getting things simple, streamlined, and transparent is super important. So we have what I kind of call a legal cost-benefit analysis, which it turns out is something that lawyers are not very good at, but economists are really good at, which is when you look at a legal document, look at every provision in there and figure out, okay, if something goes wrong and we have this provision, how much money are we going to save? Times, what's the likelihood that that thing is actually going to go wrong? So if it's a significant damage from going wrong, but has an incredibly low likelihood of happening, you can probably just remove that clause from the contract. You make the business decision to take the commercial risk in favor of making the entire document more understandable and making sure the customer gets the contract structure that you're working under. So I didn't really expect to be diving into the world of legal documents this heavily, but it turns out it's an area that's ripe for innovation. And then finally, we offer fully automated payment. So there's no invoicing, there's no check writing or anything like that. It's all deducted directly from the customer's bank account. So it's simple and quick. I just want to do a quick demo. Let's see here. You guys can see that. Okay. So this is the experience that the customer would have as they log on to the website. So if I'm a customer and I'm thinking about doing an energy efficiency project, and I don't really know if I want to do this yet, I'm not sure about the financing, I kind of want to see some basic numbers, I can log in and actually enter the cost of the project, the savings it's going to generate for me, and the lifetime of the project. And then I can actually see a graph of the savings that will result if I go with SparkFund financing. So the orange here is the monthly lease payments that I'm making over the duration of the SparkFund lease, and the green is the savings that I'm going to generate from that project after the lease. And what's really cool about this is I can select different pricing solutions depending on what my financial objectives are. So if I want to minimize my interest rate and be done with the lease as quickly as possible, I can slide this all the way over here. So I'm going to pay more than my monthly savings for the first few months, but after that I get to keep all the savings and own the equipment. If I care more about near-term cash flows than I care about interest rate minimization, then I can slide it all the way over to the right. And as you can see, I'm actually getting to keep a little bit of the savings during the lease itself. I'm only paying this percentage of those savings to meet the lease payments. And then after the lease, I get to keep all those savings. So we're not guaranteeing savings under this model, but we're helping the customer understand how a lease is going to work in the context of savings. And this is something that traditional leasing companies have not done very well at all. If you look at a normal lease, it's a 40-page document, and then there's one number there. This is how much you have to pay us every month. The key about energy efficiency is you shouldn't be focused on the payment. You should be focused on the savings generative aspect of efficiency. Right? It's actually saving you money, and it's even saving you money net of the lease payment that you're already making. So what I think is powerful about this approach is it reframes energy efficiency finance in terms of the savings that you get to keep rather than in terms of the payments that you have to make. I think that's a key kind of psychological shift. Let's see if I can scroll. We also have a kind of cost of delay metric here. So it's important to kind of prod the customer to understand that the longer they wait on doing energy efficiency, the more money they're going to throw out the window. So we kind of estimate those numbers for them. And then if they decide, okay, this sounds pretty cool. I know this isn't the final pricing estimate. We still have to do our credit underwriting and risk-based pricing to adjust this. But the customer says, okay, that looks pretty interesting. I'd like to go to the next step. They can go straight to the financing application, which is all online. And they can scroll down, enter some of their basic information, enter their balance sheet and income statement, and then they're off and running. So once they click submit, it'll shepherd them through the whole rest of the process. I'd love to get feedback on that model too during the Q&A. But one final point I'd like to make, and one sort of challenge that I often think about, in fact, pretty much every morning I wake up, I think about solving this challenge. And I think it's one that all energy innovators, anybody who wants to make energy efficiency happen at scale, needs to be thinking about and needs to be solving if we're really going to tackle this problem at the scale we need to. So here's the setup. You can think about the investor demand that's out there in the world as a positive charge, and you can think about the energy efficiency investment opportunity, the projects themselves, as a negative charge. We have good data and good knowledge from our general understanding of the market that there are tons of investors out there who want to place capital into energy efficiency. They just haven't gotten over that hump of accepting it as an asset class yet. We also know that there's this $400 billion economy-wide opportunity to invest in efficiency. The goal for us innovators in the finance space is to build the wire between those two charges. Right? It's to build the mechanism, the financing vehicles that are going to connect the capital to the opportunity. So that wire could take the form of new financial products like leasing, but it can also take the form of new consulting service offerings that help customers understand the benefits of finance better, like the one that I helped build at ICF. Or it could take the form of new programs at large companies. Like Adidas has a really innovative program where they developed a $2 million fund to invest in internal energy efficiency projects that's managed essentially like a venture capital fund. So this wire can take a lot of different forms, but there's 3 attributes it has to have, and this is where the real kind of rubber hits the road. So the first is transmission efficiency. So like any electrical system, if you're losing a bunch of energy along the line, it's not going to be a very efficient system. And in the analogous thing in the finance world is, of course, transaction costs. So as money moves from investors to projects, it has to be transaction efficient, it has to be low cost, and it has to move quickly. Second is accessibility. If that wire only connects the biggest 10% of projects to the wealthiest 10% of investors, you're not really solving the whole problem. So whatever new financing products we build have to address the full spectrum of the efficiency market, all the way from the $20 million massive university-wide programs, all the way down to $10,000 residential upgrades or less. But they should also ideally address the full range of investor demand, right? With things like crowdfunding and impact investing and a whole range of other kind of new emerging investor models. we don't want to just be taking capital from traditional sources. We want to be taking it from the full spectrum of investors. And third, I think this is the most important thing to think about, is we need massive capacity for capital deployment in this country. It's a $400 billion opportunity now. It'll probably be an $800 billion opportunity, if all else stays equal in the next couple of decades. We need to be thinking in terms of billions and tens of billions of dollars flowing into this market. So small-scale financing solutions are great. Solving the problem in a niche market is great, but at the end of the day, we need a big, fat wire that can connect billions and tens of billions of dollars in capital to efficiency projects. So this is the thing I sort of wake up every day thinking about trying to solve. I think companies like SparkFund are a good start in addressing an underserved segment of the market, but there's a whole lot of other innovation to be had with new technologies, new financing products, and new business processes here. So something to keep in mind. And with that, I think we'll do questions. Yeah.
Yeah, I had a question about the structure of your company. Oh, sorry. Yeah, I was wondering if you could talk a little bit more about the structure of your company. I mean, in the sense of, are you a commercial bank? Are you a hedge fund? Like, how exactly are you distributing funds, and are there regulations that you're subject to because of that?
There are, yeah. There's a whole quagmire of regulations, in fact. So we are a Delaware C Corp, standard C Corp, but we're a registered investment advisor. So the capacity in which we place funds is as an RIA. So that means that we are only taking capital from accredited investors, so wealthy investors plus institutional investors. So that means we're not subject to the nastiest of the financial regulations, but we do still have to be compliant with SEC regs and that kind of stuff. So we essentially have to register with the SEC as a registered investment advisor, and then do some basic accounting and compliance stuff every year. So it's a pretty common model. Many leasing and finance companies use that model. Our investors, though, are not banks. They are a mix of angel investors, so individual investors who participate through a debt vehicle. So our particular financing, if you want to get really into the weeds, our particular financing vehicle is a master feeder fund structure. So each investor invests in a feeder fund, which then itself invests in a master fund, and that master fund is the entity that actually owns the asset. So you get some isolation of risk, basically. You can have multiple feeders with different sets of investors and different risk profiles feeding into the same master fund. That's a pretty common structure. Yeah.
So you mentioned, I guess, so you showed the tool where you're describing, okay, they have a lease and they pay for a certain amount of time, and then you've got savings going on after that. So once the lease is over, do they own the equipment?
They do.
Turn it over? Okay.
Yeah, it's called the dollar buyout or buck-out model, where in sort of arcane American commercial law, ownership can never change unless somebody pays somebody something. So it's actually quite common to just have the customer pay $1 to the lessor, and that essentially transfers title of the equipment to them. So they get to keep it.
Kind of a lease to own then.
Yeah, that's right. It's an equipment lease or finance lease with a lease to own model. Yep.
I have a question on the solutions. I know there are some players in the market already. Some incumbent, they probably have like a first mover advantage, such as General Electric. So I know in my house, GE had the utility company, they installed the new smart meter from GE. Mm-hmm. So I bet that if there's any other smart energy solutions, maybe GE has a first mover advantage, because maybe I'll just continue to use the same solution from GE.
Yeah.
That's number one question. What is your solution advantage over existing firms like GE? Number two is in terms of financing. Like big firms like GE Capital, they probably has much bigger financial capability than SparkFun.
Right.
So can you comment?
Sure, yeah, happy to. On the GE question, it's interesting you mentioned GE. So they do have a capital provider aspect of their business, GE Capital. And they do work in the efficiency space. What's really interesting about them and other sort of vendor financiers is that they often create the financing arm of their business specifically to move more of their own product. Right? Because GE is manufacturing those smart meters and a lot of the other technologies, so they're interested in making more sales of that equipment. But oftentimes, they actually don't want to be in the financing business, right? If they can find capital partners that are specifically designed with a light touch financing model that they can partner with instead of doing it themselves, they often actually want to outsource that to companies like SparkFun. So we're seeing a lot of interest from companies that have historically offered their own financing solutions that actually want to find third-party solutions. In terms of the first mover advantage, yeah, there are a couple of companies out there that could potentially move into the space, or a couple of types of companies. One is traditional equipment leasing companies, right? Companies that have been doing forklifts or commercial industrial equipment leasing for many decades. They certainly can move into the space. They lack a couple of important things. Number one is installer relationships in the efficiency space, right? That is a significant barrier to entry, is having installer relationships in place and fully integrating with the sales process of contractors, because it's a very different sales process than you see in the traditional commercial industrial space. So energy efficiency is kind of unique in that regard. So we built a company that's specifically designed to integrate with efficiency contractors rather than with broader equipment suppliers. And they're often also not focused specifically on the efficiency space. So some of the tools and kind of customer experience that we're designing around the pricing engine that you saw online, the installer portal, some of the technology and transaction infrastructure that we're building is all calibrated to energy efficiency. And certainly, other companies are going to move into this space. We frankly would like that to happen. It's sort of an all boats rise with the tide scenario. This is a big, big market, and it's dramatically under-addressed. So it's going to be a long time before the kind of borders of those empires start to smash up against each other. I think this market is really just starting to develop and is in its infancy. Yeah.
Do you have any way of quantifying how much people actually save? You had on the model what they're expected to save, but is there any way you can verify after the fact, like, you've actually recouped this?
Yeah, well, coming from the background of being a nerdy energy modeler, I would love to do that. Fedora, I'm sure, would love to do that too. We're all like big energy data modeling nerds, but unfortunately, that's a problem that we're not particularly well positioned to solve, only because the transaction costs are super high for us. So we initially considered a model where we would do ongoing measurement and verification of projects and actually calibrate the lease payments depending on how much the customer is really saving in actuality. But the costs of doing that are often quite high relative to the size of the project. So we collect that data where we can. So if the contractor partner we're working with is collecting it, then we go ahead and look at that and make sure that we want to generally ensure kind of customer happiness and quality assurance for the product. But at the end of the day, we don't have a mechanism in place to do true measurement and verification. Yep.
So you mentioned that you've got a very decentralized sales force and the contractors that are out there, the local and sort of regional guys that generally don't have a strong background in selling financial products in addition to the efficiency stuff. So as you scale and that sales force that you have that you're selling to directly but not interacting with the customers as much, as that grows, how do you plan to manage that sort of the training and support of that growing sort of sales force?
That's a great question. Yeah, we do have, for that reason, obviously you can't train every contractor, right? If a contractor is going to bring you 5 deals every year or something, that's tricky from a transaction cost perspective. But we particularly focus on those contractors that we think have high enough deal volume to merit making an investment in them. So I'd rather have 50 really high quality engaged contractors that are bringing us 20 to 50 deals every year than I would have 500 contractors that are kind of sporadic in their deal generation. So a big part of that is focusing on the right contractors and then making relatively low cost, but still the right training investments in those contractors. So we at least do a video conference training for a couple days. We do a sales training for them to help, what are the talking points around SparkFun? What are the talking points around financing? We also do operational training. So we talk to their administrative staff to say, here's the process you've got to follow. We lay it out really clearly so that basically after that, they're ready to go sell and they're ready to go move deals through the pipeline really quickly. So it is going to be one of our challenges, basically a second-tier customer acquisition cost, right? Contractor acquisition cost. But I think one that's addressable with a little bit of light touch training. Yep.
Yeah, can you talk a little bit more about the composition of this $400 million target? The risk profile of building owners of the size and kind of how they fall. Is this really a good investment overall?
Yep, that's a great question. Smart people the first question they'll ask is what's the default risk on that? Because it seems too good to be true. The default risk, there's pretty good data on this. The default risk ambiently from data collected from the Vermont Energy Investment Corporation and a couple other groups is incredibly low in the efficiency space. It's actually in the 0.5 to 1.2% range. That's historical default. That's not projected. That's what's actually happened in the efficiency leasing space. It's pretty darn good. The reason for that, I think, is a couple things. One is that there's a self-selection effect for a company that wants to do energy efficiency. So if I'm a new startup, pre-revenue, focused on my core business, I'm probably not going to take time to think about shaving off 5 or 10% from my costs via energy efficiency. So companies that are thinking about efficiency, sort of by definition, have their shit together, right? They've been in market for a while. They're looking to squeeze out cost efficiencies. There's another effect that's kind of an interesting psychological effect where efficiency is perceived as super core to the operations of a building. So if we come in and install some light bulbs, even though it'd be easy to replace those light bulbs if necessary, if they default on that lease and we come unscrew their light bulbs, which we generally try to avoid, but that's sort of the nature of the business, right? You can't go rip an HVAC system out of a church, but you can unscrew light bulbs from a small business. So there is some asset recoverability here. But from their perspective, that light is sort of core to their operation. So they look at the light and they see that as a core service. So if they have a lease book of all the debt that they currently hold, and they are going to default on some of that debt, they're less likely to put efficiency towards the beginning of that list. That's sort of the effect that we've seen. So ambient default in small project market is around 1% range or lower. Certainly segments of that market are higher, segments of the market are lower. One of our biggest investments was in really good small project underwriting. We're working with a guy named Suleiman Khan, was a former finance guy who's then built several solar leasing companies since then, who has designed an underwriting model for us that incorporates balance sheet and income statement information to predict default rates. So our pricing for every deal is based on a risk-based pricing approach where we look at potential negative cash flows resulting from defaults and then price the deal such that our overall IRR on the deal to investors is going to be sufficiently high to meet their demands even in the event of default. So it's a core focus of ours, one that we've invested significant tech and finance talent in, and I think one we have a solution for. Yeah. Either one, sorry. Yeah, you, sorry.
I was curious how you sort of got to some of those savings numbers on the end, because efficiency can be so many different things. It's not just light bulbs, and a single efficiency project can have a lot of different technologies involved in it. Just curious how you managed to simplify that to here's your number.
Yeah, that's another thing that we aren't in the business of detailed energy modeling, but our contractors are. So our approach to that is we don't do the energy assessment ourselves, but we check it to make sure it's ballpark correct. So what we'll do when we bring on a contractor, this actually answers your question from before a little bit too about training up contractors, is we don't just accept every contractor willy-nilly, we put them through a vetting process. So we call a couple of their references, we talk to projects they've worked with before, we look at their business history, and importantly to your question, we look at their savings estimate methodology. So we make sure that, because usually these guys have some sort of spreadsheet or internal software that they're using to estimate savings. Sometimes it's a simple spreadsheet with a savings factor, and sometimes it's a more complicated building energy management system or energy modeling system. But either way, we look at it, we make sure that the methodologies they're using are consistent with ASHRAE protocols and investor confidence project protocols, and a whole range of there are some sort of specifications out there to make sure they look good. So we have confidence that contractor is providing decent savings estimates. Not super precise always, but they don't have to be super precise for financing to make sense. And then on a project-by-project basis, we do a light technical review to make sure that they're not knocking something totally out of the ballpark. Yeah.
This is a question from our Blueprint for Efficiency livestream audience. Does your preference for working high volume contractors conflict with the goal of accessibility? Many contractors in this space are small, hence potentially less efficient from your point of view.
Yeah, that's a great question. So far, we have not run into that barrier. I think because the space is so large, it's going to be a while before we have to start optimizing to that level. So right now, obviously, we do show a preference for the high volume contractors, but we haven't turned away a contractor yet because their volume wasn't high enough. I think that might be something we need to start doing in future, but it all depends on how our cost curve looks once we get into market, and it's very possible we can accept contractors that are generating 2, 3, 4 deals per year. It all ultimately shakes out to what our relationship management costs are for those contractors. So I'm optimistic. Yeah.
So do you have an in-house engineering team that designs energy efficiency solutions based on, I don't know, ASHRAE 90.1 stuff, or only contractors do that type of stuff?
The contractors do the heavy lifting on that. So Imagine a cash sale, a normal cash sale, where a contractor is going to a customer and saying, here's a lighting upgrade you should do, here are the specifications, here's the proposal, here's the cost, right? The contractor is doing all of that normally as part of their standard sales process. All we're doing is just coming in and saying, okay, the customer looks good from a credit underwriting perspective, the contractor looks good from a technical perspective on the project, we're going to provide financing for this deal. So everything we do is light touch. We often call ourselves a light touch financing layer that sort of comes in on top of that normal sales process. So we do have a single engineer in-house currently, who's also our director of operations, but it's really all we need for now. So we do that light technical review. So we take 15 or 30 minutes to look at the project, look at the inputs, look at the sizing of the system, make sure that it's appropriate for the building size, some basic checks like that. But the heavy duty engineering lifting is all done by the contractors. Still have a question?
Yeah.
I'm ignoring you, sorry.
So I was going to ask, so what do you think about the potential of a partnership with, like one of the mammoth contractors like JCI or Honeywell or Siemens down the road, and what mechanisms do they use right now for financing these size projects that, kind of contrast with SparkFund?
Yeah, I think the potential for those partnerships is very strong. I think right now, they are still figuring out exactly how they want to handle the small project market. Do they want to ignore it entirely? Do they want to just sell product into that market but not offer financing solutions? Do they want to try and compete by bringing up their own financing solutions? So there's a bit of decision making to be done, I think, in the large scale contractor space. But I do see significant opportunities. Just like I was talking about partnering with vendor financiers who don't really want to be in the financing space, also quite possible we can start partnering with larger contractors who don't really want to be in the small project space, but also have enormous industry connection and market presence already. So it would be sort of a shame for them to waste that presence without offering a financing solution. So it's a good question. Yeah.
A couple short ones. What's the longest term payback that you can offer? And how easy are these to transfer upon sale within that period?
Yep. They are transferable on sale. We obviously have to redo our whole credit underwriting process for the new off-taker, but not a huge deal if it needs to happen. We prefer to avoid it if we can. In terms of the longest payback period, so we recently made the decision that not all of our leases have to be cash flow positive for the customer. So you notice in that graph, if I slid it all the way to the left, the payments actually exceeded the savings. For a while, we thought, it's important to frame energy efficiency as cash flow positive. Therefore, we're going to cap the minimum term at a cash flow positive rate. But at the end of the day, if the customer wants the financing, they get the business case for energy efficiency, and they just want to do the lease quickly and get it over with, why not let them do that? So we don't restrict the payback period on the project itself. Right now, we try to target leases that last no longer than 5 to 7 years. We'd like to go longer than that in the long term. Obviously, the temporal risk of default increases when you do that. So right now, we're seeing leases usually in the 2 to 5, 6 year range. Yeah.
I was wondering if you could go into a little more detail about the cost of capital you're able to provide currently, and maybe where you'd like it to get to as you improve efficiency.
Yep, that's a good question. There's this interesting sort of valley of death, as it's often described, for new financing companies, where they can attract low-cost capital at the beginning of their life cycle for people who are just excited about the idea, right? And then later in the process, when they've scaled to a couple $100 million in deals, they can start finding, starting to find low-cost debt partners who can offer capital in the mid to high single-digit range. There's that interesting valley of death, though, where you're not quite a startup who's just selling the dream, but you're also not a well-developed, established, scalable solution yet. That's, I think, one of the biggest challenges a lot of financing companies face. I think one that we are pretty well positioned to address with a lot of our current debt partners. So we are seeing kind of long-term interest. I do think in the long term we can get our cost of capital down in that sort of mid to high single-digit percentage range. Our first couple deals are going to be more than that, but one of the interesting things we've seen in this market is that some customers care deeply about the APR that you're offering them, right? So they are going to dissect every number you give them, minimize their APR. Other customers actually care less about that. You talk about a $50,000, $100,000 lighting upgrade in a commercial, say a small business or something. As long as they can show that the cash flows are going to be there and that's a cash flow positive upgrade for them, it's relatively low risk for them, low touch, low transaction costs. They actually are interested more in just getting it done quickly and capturing those positive cash flows. And one of the things that SparkFun offers is that we let you drag that slider all the way to the right of that range. So what's actually happening in the fairly complicated math that drives that slider is the interest rate is increasing as you're doing that, but it isn't increasing payments as much as the duration is decreasing payments, right? So you're actually increasing your cash flows as you do that. So we're seeing a surprising number of customers who care less about interest rate than they do about cash flow, which we're sort of uniquely well positioned to address. But I do think we are and can be competitive on the cost of capital front directly as well. Yeah.
I know you're not tracking all of the performance for all the projects, but for the projects that you do have performance, I'm wondering what kind of energy efficiency improvements you're seeing in terms of like percentage savings in energy.
Yeah, well, we're still early stage. We just launched, so we actually signed our documents for our first project like 3 days ago. So we're early stage. We've got a strong pipeline in the works. We're actually seeing way more interest than we can find. Well, we have the capital too, but we're finding way more interest than we can sort of scale to meet at this point, which is always a good problem to have on the pipeline front. I can tell you from personal experience, there's always a range of uncertainty around upgrades, right? Lighting, we love lighting because it's good paybacks, easy to install, easy to recover in the event of default, and also it has very predictable savings. So what you see in a lot of lighting projects, and this is from my experience at ICF and at Dartmouth, is that you're often in the like 10 to 15% range of uncertainty around that, because it's a simple system, has simple parameters governing it. But if you look at something like an HVAC system, like doing a full building retrofit of the entire heating, ventilation, air conditioning system, there's a lot of interrelated systems with complex network effects. That can be very hard to anticipate what those savings are going to be. So, like I said, we don't have no SparkFun specific data on that, and honestly, I don't anticipate that most of these small projects are going to have really good measurement and verification data. But at the end of the day, it doesn't, like I said before, it doesn't necessarily matter that you have 100% confidence in exactly what the savings are. What matters more is that you understand the business case for energy efficiency, and you know that you're saving money regardless of precise amount.
Yeah, I was curious from sort of a bigger picture perspective of the potential impact of SparkFund, not just in terms of number of projects or dollars invested, but looking toward the future, being able to have some sense of, our first 5 years of operations saves companies on average 10% of their energy, or just things like that. So maybe it's something to consider for the future. That's a great
point, yeah. And also important for tracking things like carbon mitigation and environmental impact too. I agree. Yeah.
I was wondering if you could talk a little bit about the entrepreneurship side of SparkFun, and particularly what are the challenges or maybe lack of challenges in finding investors, and also sort of long-term, what's your strategy? What are you telling investors right now, your Series A investors, about where the company's growing, what the growth is going to be like, and whatnot?
Sure. Yeah, it's a good question. Well, first of all, it's just the team we've built is incredible. It's amazing to be surrounded by such intelligent people every day. I always say that if you're the smartest person in the room, you're probably in the wrong room, right? And the people I work with every day are just deeply intimidating human beings because they are so smart. But I also love them all to death. Pierre, our CEO, and I call each other our work husbands because we spend 14 hours a day together. So we have a great cohesive sort of startup-y feel. What's great, though, is that we also have a much more process-oriented, kind of disciplined approach to running the business. We're not one of these crazy Wild West San Francisco startups, no offense to San Francisco startups, but who are like, we're a $500 million valuation. Who cares about revenue? Like, it's all about user base and all this crap, right? We're not one of those companies. Most of us come from the consulting world, at least most of the co-founders do. So we are used to thinking in terms of process and discipline, and we modeled all of our costs and all of our revenue. It was like the third day that we said we were actually going to start this company. We had that all modeled out. So I think investors have responded really well to us because we bring that discipline and process focus to the table, and you don't see a lot of startups that do that. And I think as a result of that, plus this being a market that's ready to go, investors have known that it's ready to go for a long time. They've just been looking for a financing vehicle that's ready to tackle these challenges. They've just been chomping at the bit. So we raised our angel round a lot quicker than we thought we would. We actually jumped ship from our prior jobs before we had raised the full round and just raised it in a couple of months. It was very quick. And then, so that was very much selling the dream with some spreadsheets to back it up. Now what we're selling is much more than that. We're selling the functional leasing company that we have now built. So we have functional technology, we have a functional transaction engine backing it up. We have a leasing company that works from end to end. We're doing our first project now. So now the vision that we're selling to investors is scale. It's all about, all right, we're doing an $8 million pilot fund right now to kind of prove out the model, and then we're looking to scale dramatically from them. So we'd like to have $100 to $300 under management within the next couple of years. So the challenges have been, as far as attracting investor capital, have actually not been as great as we might have thought they were. There's always sort of delay challenges there. So even an investor that's interested, there's a couple of months of closing time typically where they go through a diligence process. But we were lucky to find a lead Series A investor that's really engaged and a really fantastic party to work with. Yep.
What geographic markets are you opening up in now? How did you choose that, and where do you see expansion sort of throughout the country?
Yeah, that's a good question. We are not geography constrained at all. We have no boots on the ground ever unless we do on-site training for contractors. Otherwise, it's all email and website based. So that means that we can go essentially anywhere. Our geographic focus has emerged sort of organically from where our contractor relationships are. So our first contractor partner we've known for like 4 years is based in Mason, Ohio. It's a small, primarily lighting installer there. And that has led to some more networks in kind of the Ohio area. So we see some projects there. We've got, I don't know what the latest number is, but it's in I think the 70 plus signed contractors right now, or at least heavily interested contractors that are spread across, I'm just estimating, but probably 20 states, 25 states. So no real geographic focus, and I don't see a reason why we would need to. The challenge is going to come from expanding internationally, which we may do to Canada relatively soon because it's a similar market and similar regulatory challenges. But we are looking to go international eventually as well, both in terms of projects as well as investors. Yeah.
Do financing regulations affect what states you can or cannot operate in?
It's a good question. They don't affect it in an absolute sense, but every state has its own sort of hodgepodge set of regulations that we have to comply with. So without risk of boring everyone, including myself, there's like 8 different things we have to check in every state to make sure that we are compliant. So there's usury laws. We have a meme wall at the office. So our director of operations likes to keep us in line. So she started making usury jokes. So one day she rolls up in her chair and goes, "Are you serious?" We spent a lot of time in that office, guys. So anyway, checking state level regulations is an important part of what we do. There aren't any states that just completely disallow this kind of thing, but there are states that place regulations on what the cost of capital you can offer is, or what interest rates you can offer. Sometimes you have to get registered in the state to do business. Sometimes you have to jump through a couple of regulatory hoops. So we have a review process that kind of gets out in front of those challenges and makes sure that we have everything in line in the state before we move into it.
I have more of a comment going back to your 400 billion. So I've been in this space. I kind of helped create it in the 70s and been sort of knocking on doors in this sort of underserved commercial space as an energy engineer, but also as a systems analyst. And the 400 billion that has been, is that a McKinsey number? Somebody sort of said,
yeah,
we add
based
up
on a
all
McKinsey
the
number,
energy
yeah.
audits that are going to get done and all the soft costs. There's this great opportunity to make money.
Yep.
Sort of the last part of my career, I've been trying to sort of turn the tables on that. So start from the outside saying, well, we know how many buildings there are. We know what it's going to cost to get them fixed. And we know from sort of affluence how fast that ought to take place to start to match up a little bit with the climate changes.
Yep.
I mean, we got to turn down the fires, right? So to me, we got to turn down about the fires in maybe 1 million or 2 million properties a year. That's the pace we need to be at in this sort of commercial space. And I don't know the number, but I think there are 15 or 20 million buildings that we're talking about. So thinking about them as an asset, I mean, the goal ought to be, I mean, you've got kind of a niche space. I think there is a number, and I don't know if it's the 400 billion, but the part where we know how much cellulose and how many, air handlers need to be bought and installed, we can figure that number out. I mean, it's probably, I don't know, if we were going to do 1 million buildings a year, maybe $15 billion a year.
Yep.
And we ought to be, what I caution young people is that I mean, the idea of making a living in this space is sort of contrary to the need, which is to get the job finished. So, you know, I've been at it for 40 years. The list is almost the same today as it was when I started in the 70s.
Not much of a dent.
We got to figure out, so you mentioned pace. I mean, I think that's right, or scale. And that is the word, but I think it's sort of a quantumly larger number than you're talking about.
Mm-hmm.
And if I was in the sort of, you know, fledgling analyst position or engineering position right now, I'd be thinking about how to really get this thing moving rather than how am I going to make my money in it. And
Totally.
no offense.
No. Well, that was the starting point for SparkFun. That's a really good point, and it's funny your point about thinking about this at the macro scale, not how much of this market can we capture, but where do we need to get for a sustainable economy, for an energy efficient economy, is where we all started from. So I came from working on climate change background, actually started in that kind of advocacy background, and in sitting around thinking about, okay, I don't want to work on climate change for the rest of my life. What's the most impactful way that I could do that? And the logical answer, after kind of thinking about the market for a while and thinking about where our skill sets lied as consultants and financial analysts, was getting more capital into that market. So really the genesis of SparkFun was that goal that you're talking about. It's, at some point you have to say, okay, there's an economy-wide challenge, and that is, to address that systemically across the entire economy is going to take policy. Right? It's going to take a lot of companies approaching this from a lot of different directions, but it's also going to take policy. It's going to take pricing energy appropriately for the social cost of that energy. It's going to take favorable policies at the state level and the federal level to get more energy efficiency done. It's going to take a sustained systemic effort, but then it's going to take a lot of companies like SparkFun rising to the challenge to meet that demand. So from the perspective of running a company, I'm kind of a big believer that you have to you're defined by the battles that you don't fight. And it's better to try and solve a small challenge and achieve as close to perfection as you can in that market, and then grow based on that success. So our philosophy is very much around, we're not going to do $400 billion tomorrow. We're going to do $8 million today, but we're going to do it really, really well. And we're going to prove that this works. And we're going to encourage others to enter the market and try and make all those kind of boats rise with the tide. But I tell you what, none of us are in this to make the money. The 4 co-founders were the 4 lowest paid employees at SparkFund until 2 months ago. So that is our driving philosophy. Cool. Thanks, guys.